Investing in the market involves risk. We all pretty much understand that. But did you know there are certain types of risk that are virtually impossible to diversify against? And these risks can have an irrevocable, damaging effect to your buying power in retirement if you're not careful. We're all familiar with the term timing is everything. It permeates through a lot of different aspects of life, and it absolutely plays a role in investing, specifically when it comes to retirement planning. Simply put, you cannot control the order of the various returns that you will experience when you go out and acquire various assets. They all have varying degrees of volatility. So the order in which returns take place does matter, and it matters a lot when it comes to the actual returns you will achieve and the actual buying power you'll be able to create with your retirement portfolio. The time at which you would like good things or bad things to happen differs depending on where you are in life. When you're just starting out, a bad market with declines in the overall value of assets is not so much a bad thing. You don't have a lot of money at that time, so the losses, even if they look like large numbers in terms of percentages, are in absolute terms relatively inconsequential to you. But as time goes on, a big market decline may have a significant impact on you and your portfolio. Once you've accumulated a lot of money, if a bad market rears its ugly head, that could have quite the impact on your ability to weather things moving forward. And when it comes to retirement years, a bad market at the outset could have a fairly destructive impact on you and your retirement income prospects well into your retirement future. Consider this chart here, which shows us what happens if you have $1 million at retirement and you wish to use it to withdraw $50,000 per year. From this chart here, we can see that over a 24-year period, given the rate of returns that take place here, you will end up in a very good position. You'll have nearly 3 times the amount of money that you started out with, despite the fact that over this entire time frame, by pulling out $50,000 a year, you will have withdrawn almost $1.2 million in total value from your portfolio. This is an example of the market doing unimaginable things for you. It creates a spectacular rate of return and a great accumulation of wealth, despite the fact that you are using it for income. In fact, if we go back to the chart and we look at these rate of returns that happened and we average them out simply by adding up each observation and dividing it by 24, what we get for an average rate of return over this time frame is 8.61%. That is what we oftentimes would refer to as the average rate of return over this time period. But if we want to know what the real rate of return is, the year-over-year rate of return achieved, that happens to be 8.02%, which is still very, very solid when it comes to rate of return we would seek to achieve with our retirement assets. Now, that result is quite spectacular, and I assure you that data was pulled from real stock market results in the US stock market, so it has a very good chance of unfolding. However, it also could be the case that a different scenario unfolds and it is far less better. Look at this chart here, which shows us all of the same rate of returns taking place. They just happened in a different order. They're reversed from that first scenario. So now year 1 is year 24 and year 24 is year 1. And you'll see from the data here that after 24 years, instead of having nearly $3 million, we don't even have $150,000 left. We've achieved a wildly different result, but everything else is the same. We still started out with $1 million as our account balance, and we still withdrew $50,000 per year as income from the account. That means we did actually distribute almost $1.2 million in cash from our portfolio, but we're in a much more precarious situation when we get to year 24. And despite the fact that we still have an average rate of return of 8.61%, that occurred here, Our real year-over-year rate of return is now only 2.41%. That is quite the difference in terms of results. And again, as I said, these data are pulled from real US stock market results. In fact, these are the time frame spanning from 2000 to 2023, or the end of 2023. So the second scenario is actually the real life situation where from 2000 to 2023, we saw the results and then we just flipped them in reverse for the first scenario where things worked out much, much better. But given that, it is theoretically possible that either scenario is something that could unfold for somebody who is invested in the US stock market, specifically the S&P 500. That's where those rate of return figures came from. Notice how dramatically different our real year-over-year rate of return becomes when we simply take the order of these returns and flip them in reverse. Again, I reiterate, the timing of these rate of returns matters a lot. Now, again, the good news is in either scenario, we never actually ran out of money over a 24-year period. That's a really good thing. But we did experience a large degree of volatility, and we get dramatically different results from one scenario to the other. The sequence of the returns has a very large impact on what's going on. We can, however, hedge this if we seek to reduce volatility. As the founder of the Insurance Pro blog, I've spent a lot of years talking about the virtues of whole life insurance because it is a solid, low volatility asset. It has an extremely consistent year-over-year rate of return that it can achieve. And that brings to the table a hedge, not a complete elimination, that'll never happen, but a hedge, a minimization of the problems that are posed by sequence of returns risk. Take a look at this chart here, which shows us what happens if now we only get a 4.3% rate of return each and every single year for all 24 years. This is, of course, half of the 8.6% or 8.61% that we achieved in our previous two scenarios. If this scenario folds out, and again, we have $1 million at the outset, and we withdraw $50,000 per year for income, we end up with $628,000, which is considerably more than the second scenario where we nearly ran out of money. And we do that with a much, much, much lower average rate of return throughout this entire time frame. And because the rate of return is the same in all years, the real year-over-year rate of return is still 4.3%. They don't differ in this case. But it is kind of noteworthy that our average rate of return can be half in this situation versus what it was in our previous one, and we still end up with more money. And not only that, we have enough money in this example to continue to generate that $50,000 of income at a 4.3% rate of return moving forward for roughly another 17 years. So if we assume a scenario where you retire at age 65, 24 years later, you're in your late 80s. So another 17 years is more than enough time to assume you won't run out of money before you pass away. I don't want to leave you with the impression that I'm trying to convince you should take all of your money, put it in something like whole life insurance when you get to retirement, and everything will be A-okay. In fact, if you don't own any whole life insurance by the time you get to retirement, transitioning everything at that time and trying to use it as an income tool is not going to be that easy for you, I don't think, and wouldn't really be a recommendation I would make to you. This is absolutely a strategy for early starters. So allocating some money to something low risk like life insurance earlier on would be more ideal. But the good news is if you're at retirement and you're looking at this and you're a little worried about volatility and the ability to have stable income, there are other asset options on the table that can also remove the effects of sequence of returns risk from your life. Things such as annuities that will create very solid income guarantees for you and will have zero worry about market corrections and their impact on the ability of the annuity to create income for you are certainly tools we would generally use for people in a situation where now at retirement, they are starting to worry about the risk profile of their portfolio. To reiterate, there is no control you will necessarily have over the actual sequence of returns that will transpire either during your accumulation years or your distribution years. And both can have a pretty substantial impact on what you ultimately are able to do with the dollars that you've saved for the sake of retirement or whatever else it is you're planning to do with the money. The only way you can minimize the effect of this is to look for assets that have lower volatility. Life insurance is an excellent low volatility asset. Annuities are also an excellent income producing low volatility asset. When invested in assets like stocks that are rather volatile, the truth of the matter is the accomplishments that you have in your portfolio are only as good as they were yesterday and can change in an instant in many cases once bad market conditions develop, which are pretty hard to predict in most cases. So wherever you are in life, whether it's just starting out, midway through your accumulation years, well into retirement, be aware and don't say nobody warned you. The effect of a big market decline could have a dramatic and irrevocable impact on what you can do with all the time and money you spent saving for retirement. Allocating some of your money to a low risk, which is to say low volatility position, will dramatically reduce the chances that you have to live through the pain of a significantly altered retirement situation.